As stocks closed at records, Treasury yields pulled back after the Fed decision, and Fed Chair Jerome Powell reiterated the outlook of 3 rate cuts this year. Joining us now is Adam Abbas, Harris Associates co-head of fixed income and portfolio manager. Adam, it's good to see you.
Good to see you.
So maybe listen, you heard us talking, Adam. It is risk on right now. We've got a record close for the Dow, the S&P, and the NASDAQ. So investors clearly like what they heard. But what did you make of what kind of the Fed did and said today?
Well, I think Jerome did a really good job today. I think there was a tendency, there was a risk really that he would come in and speak a lot about the last 2 inflation prints, the hotness, maybe even pivot hawkishly from a really dovish meeting in December. And the risk there is that we just have a Fed that's flip-flopping. You kind of lose credibility. And what he said, and I think he said correctly, was we had 2 data points. Some of that was seasonal. We're going to wait for more data points to confirm a trend. And he gave us evidence that the labor market can be strong as well, and that there's no reason to change estimates. You saw the dot plot still had 3 cuts. Mm-hmm. And I think all of that was appropriate. I think he did hedge with a little, we are data dependent. If inflation were to remain sticky, we would make some changes. If the labor market started to break down, we saw a tick up to 3.9%, we would make some changes. But importantly, he really didn't change his forecast, and he reiterated to the marketplace why. And I think that was a great job by him.
So do you share the sort of positive vibes that we were hearing about from our Josh Schaefer? I mean, that was mostly seen on the equity side, to be clear.
Yep.
But the idea that the Fed has done it, that they've engineered this thing, and that it's worked?
I think it's too early.
Okay.
I think
fair.
it's too early until we're down to the Fed mandate of, let's say, 2 or above, just above 2. I think it's too early to declare victory. But again, I think this is the right decision. I think he gave us evidence that he kind of leaked out. I don't know if you guys noticed that. He gave us the current PCE print that was intentional to basically tell the marketplace, hey, those were anomalies more than they were at the beginning of a trend for inflation. He he talked about the labor market supplies coming back, can protect from a big movement higher in unemployment. So he gave us all the right data to imply that they're not going to really shift course and that they're ready to cut when you get inflation below, let's say, 2.5%. And if you think about the skew here in the kind of the framework, if the labor market goes bad, we're going to cut. If inflation comes back down from those 2 anomalies, we're going to cut. And we're not going to raise rates from here. So we kind of are skewed to a dovish stance.
I'm looking at there's a 10-year right now. I mean, so 4.3. Call it. Where do you think the range is there? Near to intermediate term. We were talking to another fixed income strategist earlier in the show. He actually thought you're kind of range bound here, 3.8 to 4.3. What do you think? I
think that's right. I think the 10-year is probably not too far off where it should be. At Harris, we kind of look out 3 to 5 years. We think fair value is kind of around 3.5 to 4.5%. Where I think it's attractive right now is kind of in the belly of the curve, the 5 and the 7-year part of the curve. You can get real yields for, let's say, 5 years above 2%. And again, if you think the Fed will meet its inflation objection, you should see what's happening today, which is a curve steepening. And it'll benefit the 5-year, 7-year part of the curve, and it'll hurt the longer end of the curve. So we like to be in that 5-7-year part of the belly. We think inflation, they'll have success. It will come down. Now, timing's, the question mark here. And if you notice, he didn't say, yeah, we're going to cut, but we're not going to cut necessarily over the next 2 months. It may take 6 months. We may be patient. And that's the kind of that last variable here.
Right.
And I think that's important. He's kind of given himself that flexibility, give himself a little out if some new things are introduced to his framework that may cause him to be a little bit more hawkish.
Does that also imply then just not a lot of Treasury market volatility this year if you see this?
I think so. I think what my expectation over the next 12 months is that as we get closer and closer to the actual cut cycle, and we can really lock in on inflation is going to come down and stay down, and that the labor market is okay. It's going to be somewhere between 3.8%, 4.25%, but there is no big spike in unemployment. Then the Treasury volatility will be lower and more range-bound as we just have more visibility and more confidence. The market has more confidence in the outcomes here. So that's good for all markets.
Besides the 5s and 7s, what's exciting in that sort of implies that the fixed income market is not as exciting right now, which has pros and cons.
Yeah.
But are there places that you think are being overlooked right now?
Well, I don't necessarily think overlooked, but I think this might be a boring answer. But if you can get 3% real yields in high quality investment grade corporate credit. And we believe that inflation is going to come down to 2.5%. And there's not structurally sticky inflation that's a lot higher than that. Then real returns of 3% annualized in asset class that defaults less than 1% annually, that seems really interesting to me. So maybe you can classify it as boring,
Stability
but
is
interesting
exciting,
to me.
I guess.
That's exactly right. So I think it's not the time to really be too adventurous and go reach in the lowest quality parts of fixed income. Here, I think the most attractive risk-adjusted returns really are in high-quality fixed income, U.S. Treasuries, agency-backed securitized over the next 3 years.
Adam, great to see you.
Yeah, great to see you guys.
Glad you could be here today.
Yeah, great to see you
Appreciate
guys.
it.
Thanks.
Adam Abbas of Harris.